Stagflation is coming, but not in the way many investors think. The 50 years since low economic growth and high inflation last hit means there are a lot of misconceptions about how stagflation of the 70s affected stocks. It's kind of like how you remember your high school like this, when it was actually a lot more like this. In this video, I'll explain stagflation, what it is and what causes it. I'll show you why we could be heading towards the worst stagflation in decades and how it's going to affect the stock market. I'll then reveal 3 investments to buy and 2 to avoid in the coming stagflation disaster. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, prices in America more than tripled in the 16 years to 1982. You see here the Consumer Price Index, a measure of prices in the US from 1966 to 1982, tripling over that period. That's an annual inflation rate of 7.2%. Put another way, imagine if your monthly rent jumped from $1,100 a month, that's the average in the US right now, to almost $3,500 in that time. Or imagine that $15,000 in savings you've got stashed away for emergencies. Imagine that now only buys $5,000 worth of the things you need. Not only was the 1970s one of the worst decades for investors, but it destroyed anyone saving their money. The combination of high price increases and low economic growth set the economy back decades, and all signs are pointing to the potential for it to happen again. Now I'm going to start with a quick definition here because there are a lot of misconceptions about when stagflation happened last and how it affects the stock market. I've included a clickable index in the video description below, but please watch through this video because you need to know the warning signs as well as just the stocks to buy. Nation, the best time to put on your life vest is before the ship is sinking, and what I'm about to show you now is going to help you find that life vest when the stocks hit a stagflation-sized iceberg. I'll be sharing 3 stocks to watch ahead of stagflation later in the video, but if you want to see the 5 stocks I'm buying no matter what, check out the free report in the description below. These are the 5 biggest stocks in my portfolio, and I'm going to show you what they are in that free report, so look for that link in the description below. Before we look at how stagflation affects stocks, we need to explain what stagflation really is and what it means for you. And the definition here is surprisingly simple. Stagflation is just a combination of stagnation and inflation. It's when you have higher inflation and lower economic growth. Now that's it. It doesn't have to be double-digit inflations or even in a recession. You just need an inflation rate that is above the rate of economic growth to completely destroy people's savings and their investments. And now the thing about inflation is that it's so much a function of what people expect that once you start down that path, you're totally screwed. Just the expectations of those higher prices means people start demanding higher wages and companies start raising their prices to get out in front of it. And that keeps you in that inflationary cycle. Think about this. The last run of stagflation actually started in the late 60s. It was 1966 that inflation really started taking off after a decade of bad policy decisions, and price increases didn't cool off until 1982, 17 years later. Now, prices increased at an average of about 7% a year over that period, while the economy grew just 2.2% annually. Think about the things that you're planning over the next 17 years and how they'd be affected by prices becoming 3 times more expensive. Planning your kids' college tuition? Sorry, Timmy, ain't gonna happen. Planning on retiring in the next 17 years? Think again. So then what causes stagflation and why might we be on an unavoidable path to higher prices? The most misunderstood thing about stagflation is that most people think it's just caused by too much government spending that boosts inflation higher. Now this is a factor, but if we really boil it down, it really breaks down into a crisis of confidence in the US dollar. This is why we see runaway inflation during and after wars. Not only does government spending increase and deficits get out of hand, but people just generally lose confidence in the value of the dollar. If we look at the Consumer Price Index since 1947, you can almost dot the biggest price increases with the major wars. You had World War II ending in 1945 and then Korea in the early 50s. Spending and the crisis around Vietnam set up that inflation of the late 60s into the 70s, and inflation spiked again in the early 90s with the first Gulf War. Between Vietnam, Watergate, and eventually taking the dollar off the gold standard in 1971, the public's faith in the greenback was smashed, and investors rushed into real assets that could hold their value against a worthless currency. Inflation touched nearly 15% before coming under control in the early 80s, and if you think it can't happen again, all the signs are there. First here, I want you to look at this chart of the M2, which is the amount of money in the system here from 2017 to July of this year. And this shows the percentage increase each year, so how much the government printed and pushed into the economy. Before last year, it was a fairly consistent, around 5% a year. The amount of money in the system grew by about 5% a year. But then we dialed it up to as fast as the printing presses would go. Over the year to January, the government increased the money supply by 25%, more than 5 years of printing in a single year. Now that massive stimulus of money creation likely kept us out of a depression, but the bill comes due. It always comes due. We are already seeing this in home prices, which have jumped more than 16% in the last year, the fastest growth since the very peak of the housing bubble. In fact, it's an increase in home inflation that we've only seen about 4 times in the past 60 years. We've also seen consumer prices jump to their highest level in decades. Prices increased by more than 5% over the last year, an increase we've only seen twice since that era of stagflation. And now the Fed and all the economists want to say, don't worry, inflation is just going to be temporary, nothing to worry about. But the danger is that it's anything but short term. In fact, we might not even have seen the worst of it yet. If you compare the increase in rents over the last year with that in home prices, rents have only increased by about 2% on average against that 16% surge in home values. And that's because those eviction moratoriums have kept landlords from raising rents for fear of not getting anything and not being able to evict tenants. And what happens though, as those eviction moratoriums come off and the rents catch up with home prices, that owner's equivalent rent that accounts for more than a third of the entire consumer price index is about to surge higher as rent increases take effect. Add to this those wage increases that are just starting to show through on a tight labor market, and we're going to see high inflation well into next year. Inflation is heading higher, and it's not going to be short term. The only thing we're missing then is slower economic growth for a full-on bout of stagflation. And that could be on the way as well. The US economy could be about to hit a brick wall, and economists at Goldman Sachs believe we could see growth as slow as 1.5% by the second half of next year. In fact, former Italian Prime Minister Monti believes stagflation is the #1 threat to the European economy and is likely to hit globally. Niall Ferguson is predicting a 60s-style setup where the Fed lost control of inflation and started that 17-year cycle. Now this time around, we don't have a war to contend with, but just came off 20 years of wartime spending along with the war against the pandemic, and we're already seeing a historic crisis of confidence in the US dollar. The dollar's share of international reserves fell to a 25-year low last year. Nobody wants to own a currency that is being massively devalued by stimulus spending. I'll show you how stagflation affects the stock market next, but just as important, how does it affect your personal finances and your job? Everyone wants to talk about stagflation and stocks, and yes, this is an investing channel, but the effect here on the rest of your finances can be just as brutal. Your job could be the first to go as stagflation hits higher employment because of slowing economic growth. Companies aren't able to pass on all their higher costs to consumers, so lower profits means less hiring. Unemployment jumped to 6% early in the 70s and stayed there for most of that decade, hitting 9% in 1975 and peaking at 11% in 1983. Then, after stagflation makes you unemployed, it destroys your savings with rising prices. So here, when you thought that $30,000 in an emergency fund was gonna be enough, now it might only buy $10,000 worth of the stuff that it bought before. That's one of the biggest hits from stagflation. Anyone living on a fixed income like seniors or cash saved away, cash is trashed and savers are destroyed. And the problem here, the reason that earlier bout of stagflation lasted 17 years is because the Fed is powerless to fix the economy. The central bank can't just lower rates or pump more money into the economy to juice growth because that inflation is already too high. The Fed runs by 2 rules: maximum employment and stable prices. Even if unemployment is high, it can't let inflation get any further out of control, so pretty much just has to sit there and watch all this happen. So then what are the best and worst investments that you can buy before stagflation hits? And one of the biggest surprises to how stagflation actually affects investments is that it's not the bond destruction that people usually think. You see, the conventional wisdom is that inflation just destroys the value of bonds. Is since bonds pay a fixed payment and a fixed interest rate usually, as inflation increases, then those payments are worth less. The result is that as inflation and interest rates increase, the value of bonds fall. And while all this is true, the return on a bond portfolio actually beat stocks over the worst stagflation years from 1966 through 82, and and they beat inflation as well. A portfolio of corporate bonds returned 7.4% versus inflation of 7.2% over that period. And the reason here is that as those bonds mature, they pay back the investment regularly, so you're able to reinvest that money at new, higher interest rates. Now, this means heading into stagflation, you want to focus on shorter term and intermediate bonds so you're getting all that money back faster and can just reinvest it as inflation picks up. A good example of this would be the Vanguard Short-Term Bond Fund, ticker BSV, with its 1.5% dividend yield. Now, the fund holds thousands of bonds, and U.S. Treasuries or investment-grade bonds, really the safest fund out there. But what's more important, though, is that the fund has an average duration of just 2.8 years. Now that means the average bond held in the fund matures in less than 3 years, and the fund is going to be able to reinvest that money constantly, collecting those higher yields. Stocks are really where the biggest problem with inflation is seen. The Dow Index hit 1,000 in January of 1966 and didn't break that level again until 1982. It was only through the dividend yields that investors actually came out ahead and produced a 6.8% annualized return. Now, that underperformance in stocks versus bonds might not work out the same over the next few years, but it is important to understand that stocks aren't always the cure-all most investors think when planning for stagflation. Now, stocks that may do better could be in the consumer staples sector, so think companies selling products that you need to buy every day or every week. Companies selling packaged foods can better pass along that inflation and those higher costs because people always need to buy food. Stocks that tend to do worse against inflation, though, are those without that pricing power and that depend on the strong economy. So think growth stocks and technology companies. These companies get the double whammy because a slowing economy isn't enough to help the growing sales that investors expected, and they aren't able to increase prices on their products because of competition. Of course, gold was the standout investment in the 1970s. Gold only began freely trading in 1971 at $35 an ounce when Nixon took the U.S. off the gold standard, and it surged to over $800 by 1980 for a 41% annual return. Less than 10 years invested in gold would have made you 24 times your money. Now, some investors are saying that gold is already pretty expensive, so we might not see that same kind of returns over the next few years, even if inflation heats up. In fact, if you look at the return on gold over the last 50 years, it's produced an 8.2% annual return and 9.4% over the last 2 decades. So I'd agree here that it's probably a little overvalued at this point unless we get extremely high inflation. Finding the best investments during stagflation is really about dissecting what inflation really is, and that's by definition when the dollar isn't worth as much as it used to be. So understanding that, you just need to look for those assets that are going to hold their value, what's called real assets. Now, these include things like commodities, so gold, but also real estate and even cryptocurrencies. If the dollar is going to be worth less, then you need to be putting your money in hard assets or digital currencies that are going to preserve that value. So we know those higher level assets. Now, what are the best stocks to buy and the ones to avoid in front of stagflation? And here, besides making sure you have those investments in real estate and cryptocurrencies, I would focus on dividend stocks. Now, these are a strong bet against inflation because that constant cash flow can be spent or reinvested at those higher rates. Most dividend stocks, like the 3 I'm going to highlight here, also tend to be companies in stable, mature industries. One of my favorite dividend stocks, period, is Arbor Realty Trust, ticker ABR, with its 7% dividend yield. Besides just a solid company all around, it's positioned against stagflation as a direct lender to multifamily, senior housing, and other commercial real estate properties. Arbor has grown the dividend by 16% annually over the last 5 years, and real estate is going to be one of the best sectors if we get that hit on inflation. Shares of Goldfields Limited, ticker GFI, are down this year, but only after a solid run over the last few years, and pay a 3.8% dividend yield. Now, Goldfields is a large, diversified miner with an all-in sustaining cost of just $1,079 per ounce, which means it's already making a sizable profit and could see that increase if inflation takes those gold prices higher. Our third stock to buy for stagflation is one of the largest MLPs, Energy Transfer, ticker ET, with its 6.3% dividend yield. Now, Energy Transfer is possibly the best MLP in the industry, with a very strong balance sheet and diversified revenues across storage, transportation, and terminals. Now, higher inflation could easily send oil prices over $100 a barrel, and the last time that happened, shares of ET were trading at over $30 each. On the other hand, there will be a lot of stocks that could be crushed by stagflation. These are going to be tech and growth stocks that are going to get hit not only from the slowdown in the economy, but also as they struggle to pass on those higher costs to their customers. So here I'm thinking stocks like Shopify, which could see sales fall as consumers shift to those necessities, as well as a seller market that might have a hard time passing on those higher costs. Other tech stocks, for example, like Garmin, that could suffer on valuation that's already pricing in years of sales growth that probably won't materialize if the economy slows down. Don't forget to click through to get your free report on my top 5 stocks with the link in the video description below, or click on the video to the right for a 7-step checklist for finding the perfect dividend stocks. Join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.